Stock market trading. Level 1. Risk and position management. Risk and position management. Managing a position. Before we enter a position of risk, we must examine the target and analyze the stop-loss points and define them in advance. What are the main reasons for stopping loss points? In case of a stop-loss order, the trading company or broker looks at the trading discipline to help the investor cut losses by the current market bid price, and vice versa while selling a stock. A stop-loss order is basically a tool used for short-term investment planning. It is used when the investor doesn't want the pressure of monitoring a security on a day-to-day basis. The trade gets triggered automatically and the limits are decided in advance. We must also have a comprehension of why we manage risk. Why do we manage risk? We manage risk because it allows us to discern between multiple actions and by using the tools we have learned, select the right course of action that will benefit all parties concerned. These are a few examples which can help manage risk. The size of your position, hedging, taking multiple positions at once in opposing markets, trading during certain hours, stop losses and take profit levels, knowing when to take losses, an important way to getting an acceptable risk-reward ratio established and stick to it. Risk-reward ratio. Some people start their first good ratio for their first target at 1:1 or even 2:1, where your profits will double that of your maximum loss. Therefore, even if you had 3 losses, you would only need 2 gains to certify your overall profits be more than your losses when sticking to this risk-reward ratio. We're going to look at 2 examples, both starting with $10,000 and using the 2:1 risk-reward ratio, but applying extremely different routes of money management in their trading. The initial trader uses a highly assertive approach, risking 60% of his capital on every trade, and striving to make a profit at 120%. Meanwhile, the secondary trader is more cautious and only risks 5% of his account assets target in profit of 10%. For ease, let's say that both traders had the same set of 10 trades, and that each second trade was profitable. These tables show the trading results of 2 traders using different levels of risk management. Even though both strategies had equal rates of success, the same initial capital and the same 2:1 reward risk approach, because of a severely dissimilar money management style, the final results differ considerably. The first trader's aggressive approach resulted in a total loss of 47%. However, the second trader enjoys almost 25% total profit at $12,462. Therefore, you can see how a small adjustment to your approach to risk management could give you healthier returns. The correct risk-reward ratio is critical to helping avoid loss over time. Our targets are determined according to historical behavior, support, resistance, and round numbers. Risk management. The process of identifying, analyzing, assessing, and communicating risk and accepting, avoiding, transferring, or controlling it on an acceptable level, considering associated costs and benefits of any action taken. The process of determining maximum levels of risk through risk assessment, then strategizing to reduce or control the chance of loss and maximize the opportunity to gain. How do we do that? Things you need to understand about risk management. Respect price. Respect risk and always be prepared for any outcome. There is always a chance of being wrong on a trade, as there are no assurances that price will move up or down at any point in time. Always have a risk-reward ratio that you do not stray from. Account management. It is best practice for your risk per trade to be no more than 1% or 2% of your account balance. Moving averages. A tool that helps us to confirm the trend and to alert us of a possible change in direction. The moving average is calculated according to average closing prices during a defined period and appears as a continuous line on the chart. Moving averages are not the only tool used in the decision-making process, but should be one component that forms a trading idea. The main idea is that you shouldn't risk more than 5% of your total capital in a position. The purpose for this is that trading is centered on probability, and you ought to give your strategy a venture of assessment to ascertain whether you have a larger probability of achieving success rather than defeat. The simple moving average is a popular trend following indicator. When graphed on a chart, it filters out the day-to-day noise in security prices, revealing the longer-term trend. The following chart shows the TSPC fund along with its 10-month SMA. Investors can use the SMA as a signal to time and the buying and selling of a security. In an upward trend, the investor buys the security when its monthly closing price crosses above the SMA, rides the trend, and then sells it when the trend direction reverses and the price crosses below the SMA. Below is the same chart as before, with the buy, B, and S sell trading signals added. You can see that the strategy had its last buy signal on the 31st of January 2012. Fibonacci. Fibonacci, who lived from 1175 to 1250, was an Italian mathematician from the Republic of Pisa, considered to be the most talented Western mathematician of the Middle Ages. Fibonacci popularized the Hindu-Arabic numeral system in the Western world, primarily through his composition in 1202 of lvl1. He also introduced Europe to the sequence of Fibonacci numbers, which he used as an example in lvl1. Number series. The Fibonacci sequence is the series of numbers 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, etc. The golden ratio. And here is a surprise. When we take any two successive Fibonacci numbers, their ratio is very close to the golden ratio, which is approximately 1.618034. The Fibonacci numbers are significant because of the so-called golden ratio of 1.618. In the Fibonacci sequence, any given number is approximately 1.618 times the preceding number. This golden ratio is ubiquitous in nature, where it describes everything from the number of veins in a leaf to the magnetic resonance of spins in cobalt niobate crystals. Many traders believe that the Fibonacci numbers and golden ratio play an important role in finance. In particular, many traders are focused on three percentages based on the golden ratio, including 38.2%, 50%, and 61.8%. These ratios are created by dividing the next highest number. Using this technique, traders can calculate percentages as high or low as needed. These percentages are applied using many different techniques. Fibonacci retracements. These are horizontal lines on a chart that indicate areas of support and resistance. Fibonacci retracements are the most common form of technical analysis based on Fibonacci numbers, which can be seen in the example chart shown. The usage of the Fibonacci studies is somewhat subjective, since the trader must use highs and lows of their choice. When building trading system, traders must choose to select a high and a low during a set period of time. Many traders use Fibonacci numbers and lines in conjunction with other forms of technical analysis. For example, traders may look for confirmation of a breakout from a Fibonacci retracement by looking at on-balance volume or the relative strength index. These studies may also be used in conjunction with chart pattern analysis, such as ascending triangles or flags to calculate take profit or stop loss points along the way.